Welcome traders to our OTC price action course. Yes, it is a OTC price action course, including our campus indicators. We had a break a while because we are busy, right? Or I am busy. So I am more live, right? Forex, futures, grid, then also what is the breakout room, right? I have a lot of mentorings. That's the reason why I'm back, and we will finish the last price action lessons. This is a theory, okay, only the theory about the bearish engulfing. And let us start together. It would be a little bit quicker than the other sessions because it is always the same, right? We know the option number 1, option number 2, option number 3, enter trade to enter. We know how to read the indicators and so on. Means, okay, let's talk about the bearish engulfing, a very important tool. Again, it's a bearish price action candle, the theory, and of course also then how to trade the bearish engulfing. First, what is a bearish engulfing? A bearish engulfing is a candle that closes lower than the previous candle low after opening higher than the previous candle high. Okay, very important sentence here. It means the bearish engulfing, that's a red candle here, okay, the last candle on the right side here, okay, that closes lower. Look, where is the close here? Then the previous candle low. The previous candle low is here, okay. After opening higher, that was opening, and then look, we moved higher and higher than the previous candle high. Okay, the high is higher than the previous high, and the low is lower than the previous low. The bearish engulfing pattern is a 2-candle reversal pattern. 2-candle means this is engulfing, that's a bearish engulfing, and we have to check also the previous candle, always 2, okay? The second candle completely engulfs the previous candle, okay? That means this candle here has to completely engulf with the high and the low our previous candle. The bearish engulfing pattern is a 2-candle reversal pattern. The second candle completely engulfs the entire range of the first one, of the previous, okay, including the wicks, and closes lower than the previous low. Trader should look not only to the candle which formed the bearish engulfing, right? That's a huge red candle. But also to the previous candle. That's very important here. A bearish engulfing pattern represents a day in which bulls controlled the price in the morning, okay, only to have very decisively take over by the end of the day. Okay, it means we moved first higher, okay, the bulls are in the game, we moved higher above the previous low, look, very bullish, and then end of the day, by the way, end of the week, okay, it depends on the time frame, boom, we got a huge drop. That is the bearish engulfing. The key takeaways for bearish engulfing is the location first, or the position. It's not the location, it's a position, okay? It is a bearish engulfing. That means you want to short. You want to short the price. Means the bearish engulfing typical occur on the price top, okay? Should be on the high or higher high to trade the correction, right? Should we got the bearish engulfing here or here, we can trade the correction to the higher low, or also to trade the impulse on the lower high, okay? Means, okay, impulse, correction, we create a bearish engulfing in the lower high area, okay, great, you can trade the impulse all the way down to the lower low. That's a position. Next one will be the lows and highs. The lows and highs must be engulfed on the same level or higher than the previous candle. Okay, that means necessary is a minimum that we engulf the same range, the same high than the previous candle. It is not necessary that we move higher. It is okay, it's fine, it's also a little bit stronger than, right? Very clear, but it is enough should we only arrive to this high here. Not necessary. Should we move higher, then it's absolutely fine. And then, of course, we need a clear lower low. We need a clear low. The low from the bearish engulfing has to be lower than the previous candle low. That is important here. A low on the same low on the same price area is not enough. Okay. Here it's nice to see, right? That is a previous candle. Here it is a gap open because we opened a little bit higher, fine, we are above, then we got a little bit more strength from the bulls, and then end of the day, end of the week, we got a huge drop, lower, the closest lower than the previous low. Structure, bearish engulfing candle completely engulfs the entire range, okay? Completely engulfs the entire range. Look the range, high and low, the high is higher, the low is lower. Important here, right? Important is that we have the low below the low from the previous candle. And of course, it is a sell action. Bearish engulfing indicate a potential price reversal to the downside. We want to short in the bearish engulfing, right? Definitely short. Key takeaways indicators, very quick. It is either right, it is a bearish reversal, it's a bearish engulfing. Of course, it would be the best. It's not necessary, but if you want to combine the indicators also, then we are on a selling point, not on a buying point. Okay, we need a selling point, and should we create the bearish engulfing on the selling point, the seasonality selling point, perfect. Seasonality is in line. Also valuation against your specific assets, that depends on you. For example, gold, US dollar, and Japanese yen make always sense. And if you check the price, okay, we are bearish in the valuation, perfect. COT, of course, it is only possible for futures only, and here our idea, our example is the gold here. Then look, gold is in the bearish area. COT means the commercials are bearish. Perfect. We expect that the commercials are still bearish, right? And will sell the price again and again. And last but not least, the trading day of the month. Of course, it would be nice should we have, upsala. What is this? 1 second. Okay, 1 second. Let me check the screen share. Yes, it worked. Trading day of the month, of course, we are looking for a bearish cluster. That would be the best, that our selling point is a part of a bearish cluster, not a bullish cluster. Means here the white numbers, right? The gray numbers, not a huge green one, right? That means, okay, we expect more bullish movements. Okay, that's it. That's it for the idea behind. Now we will talk about how to trade the bearish engulfing. And we have, of course, 3 different options to enter. And they're not different. They're not different to other bearish reversals, right? It's always the opposite to bullish reversals. But here it is the same like the hanging man, for example. Number 1, bearish engulfing. Key takeaways must be met. Okay, that means remember here on our bearish engulfing key takeaways here, there must be met. Okay, and of course they're met. Why? The reason is the high is higher than the previous high, the low is lower than the previous low. Very easy. And of course, it's not the low, the close from the bearish engulfing is important. The close of the bearish engulfing has to be lower than the previous candle low. Okay, that's important. Okay, analysis, lower high. We're in the lower high area. We have a downtrend here. We create a bearish engulfing, action short below. Number two, as soon as a bearish engulfing is completed in its respective time frame, and it's a weekly time frame, means we have to wait that we will see a close of the candle. Means a Friday is not good enough. We have to wait for the next Monday. Okay, we mark the bearish engulfing high and the low. The entry, the short order here, is set slightly lower than the low to avoid possible fake. That means that's a low, your short is a little bit lower. Should we get more weakness, you will be filled, and that's fine. Number four, stop loss is set with a respective distance. For example, blueprint stop loss, additional 33% above the bearish engulfing high. Pros and cons here for this option. Number one is the reward is less most of the time, less because we have a huge candle, right? That is one. That's your risk is one here. You have to make 100% to get a 1-to-1. That means it is here, right around this area. You have maybe enough profit margin, but it is most of the time less. Okay, the trigger probability is of course the best of the best because we need only more weakness and we are filled. We don't have to wait for a retracement like this. And the protection is also one of the best because it is far away. It is above the high and it is above the pivot lower high. Okay, that is option number one. And now option number two. Number one is always the same. Point one is the same. Bearish engulfing key takeaways must be met. Number two, as soon as the bearish engulfing is completed in its respective time frame, we mark the bearish engulfing high and the low. Okay, high here, low here, done. Number three, the entry short order can be made market or as a set within entire range of the bearish engulfing. That means we will short here, we will short here, we will short here or here. Okay, that depends on you, right? That you can say, okay, I expect or I will wait for a retracement. We moved a little bit higher and it will sell here. That is up to you. You can wait also for Monday, for the Monday close, for Tuesday opening, for Wednesday opening, and then look where you are Wednesday. Wednesday you are here. Okay, short market, stop loss above the high, and then enjoy maybe another ride. We have enough protection. Reward is of course, better than option number one because we will get a better entry higher. We will sell gold a little bit higher. Trigger probability is not the best. It is more in the middle because maybe we will never get a retracement. We get more and more and more weakness. We will never come back into the range. Then we are not filled. Protection is the same like option number one. Option number three, and that's our last option here, is of course number one and two is the same. Bearish engulfing key takeaways must be met. As soon as the bearish engulfing is completed in its respective time frame, we mark the bearish engulfing high and low. High and low is here from the bearish engulfing. And now number three, the entry short order can be made market or as set with an entire lower time frame supply zone of the bearish engulfing. And here LTF, that is important, short within a lower time frame zone. And if we check here the downtrend, look, the box here, the blue box, is our lower time frame, and this is our 60-minute time frame. You see here that is a huge drop. That's not the bearish engulfing is here, right? The same area and also a lot lower. And this is a part. this supply zone here, okay, is a part of the supply of the whole range of the bearish engulfing. Means, okay, we found here high quality supply. We will set this one, or you'll wait, of course, for a market. Should we deep inside, you can click also in the market area. Up to you, right? It's always up to you. Set is more like set and forget and get alive. Market is, okay, you has to be in front of your screen. Yes, look, this is supply. I found this on 60 minutes. This is a part of the whole range of the weekly bearish engulfing. Look how small is it on 60 minutes, right? We will increase our profit margin to the moon. Means, okay, reward is, of course, really, really good, right? Trigger probability, close to less maybe, or 50%, right? We don't know. Maybe, again, we will never get a retracement. Then we will be not filled. Protection is okay. It is okay because we have supply, high quality supply for us. The stop loss, of course, the stop loss is always better. That's a little bit wrong here. The stop loss is always better above the bearish engulfing high, the pivot area. That's a little bit more less here. Sorry for that. That's a mistake. Let me replace this one. Okay, now it's fixed, right? It's definitely not the best. The best is with a stop loss above the bearish engulfing with to cover the lower high, but it is fine. We have if you found high quality supply, then your stop loss make also absolutely sense. Lower time frame stop loss protect. Okay, sorry. I mean sorry, this is a long time ago. Protection with a stop loss above the pivot make absolutely sense. It's really good. Lower time frame stop loss protect just a little bit more or less because yeah, we covered not the we'll not cover the pivot. Okay, that's it. Very quick, the theory about the bearish engulfing. Again, it's not different, right? It's the opposite to bullish engulfing, of course, but the enter opportunities are the same, like a hanging man or shooting star. Okay, that's the reason why we are a little bit quicker here. Practical application will be the next lesson, number 3. Okay, I will show you in the chart how to find these levels and how to trade.